major banks collapse, second and third largest failures in U.S. history. On Tuesday, March 7th, Gregory Becker, the chief executive of Silicon Valley Bank, leaned back in his chair at a tech conference in San Francisco's luxurious Palace Hotel and delivered a bullish message about how the tech industry was doing so well, how SBV was sparkling in it. However, by Friday, Silicon Valley Bank was dead. As a result, Signature Bank customers, spooked by the sudden collapse of Silicon Valley Bank, withdrew more than $10 billion in deposits. This ushered in the second and third largest bank failures in U.S. history, and they were both shut down by authorities. Meanwhile, Silvergate Bank, a bridge bank for some of the largest crypto firms in the world, is also closing down and voluntarily liquidating its assets. The closure of these banks highlights the potential risks and volatility in the banking industry, especially in relation to emerging technologies like cryptocurrency. It also underscores the importance of regulatory oversight in ensuring that depositors are protected in case of bank failures. In this video, we'll walk through the largest bank collapses in U.S. history and the causes that led to the downfall of these major financial institutions. Hi, you've reached Finance Sense, the place where we discuss all the most recent trends in the financial markets and the economy. Before we get started, make sure to give this video a thumbs up, hit the bell notification button, and subscribe to our channel so that you can stay up to date with our new videos. Having said that, let's get started. On March 10, 2023, a bank run and a capital crisis brought about the second largest failure of a financial institution in the United States, the Silicon Valley Bank or SVB bankruptcy. And now, state authorities in New York shut down Signature Bank, the third biggest collapse in U.S. banking history, only 2 days after authorities shut down Silicon Valley Bank in a collapse that left billions in deposits vulnerable. On the other hand, Governor Kathy Hochul attempted to assuage depositors following Signature Bank's closure, which had recently begun servicing the cryptocurrency industry. So, what exactly happened? Signature was a commercial bank that catered to private clients and had branches in New York, Connecticut, California, Nevada, and North Carolina. The company was involved in 9 different national business lines, such as commercial real estate banking and digital asset banking. In a February press release, Signature Bank stated that Eric Howell, the bank's chief operating officer, will succeed Joseph DePaulo as CEO in 2023 and move into a senior advisor position. DePaulo has been Signature's president and CEO since the company's founding in 2001. Following the takeover of SVB Financial Corp., Signature experienced a crisis of confidence that resulted in a bank run that cost the company billions of dollars. Barney Frank, a member of Signature's board of directors, stated, "SVB induced the panic. As per the New York State Department of Financial Services, the FDIC or Federal Deposit Insurance Corporation now assumed control of Signature's assets worth $110.36 billion and over $88.59 billion in deposits." Moreover, the U.S. Treasury Department and other bank officials issued a joint statement promising that no losses would be incurred by the taxpayers and promising to fully reimburse all Signature Bank and Silicon Valley Bank clients. However, investors were alarmed by how quickly client withdrawals brought startup-focused SVB, the 16th largest lender in the U.S., to its knees. The incident caused U.S. banks' market value to drop by more than $100 billion, prompting government officials to move quickly to regain public trust in the banking system. In addition, the FDIC set up a bridge successor bank so that depositors could access their money as soon as possible. The FDIC stated that all depositors and debtors of Signature Bank would instantly become clients of the bridge bank. Former Fifth Third Bancorp CEO Greg Carmichael has been appointed as the new CEO of the bridge bank. Furthermore, the federal government said they will take additional steps to strengthen deposits and attempt to contain any further damage. Authorities stated the top executives of both institutions have been replaced and that shareholders and some owners of unsecured debt of Silicon Valley Bank and Signature Bank will not be protected. Officials have stated that As mandated by law, a special assessment on banks will be used to recoup any losses sustained by the FDIC's Deposit Insurance Fund used to help uninsured depositors. Meanwhile, a second big bank, Silvergate, is likewise closing down and voluntarily liquidating its assets. Before falling to approximately $5 per share today, the stock reached a high of $220 per share. Silvergate Bank was created for some of the top cryptocurrency exchanges using the Silvergate Exchange Network, often known as SEN. Big-time businesses and traders may move their money in and out around the clock thanks to this blazing fast bridge between cryptocurrency assets and dollars. Even though it was used by some of the largest crypto firms in the world, the system is being shut down without warning. Large banks and dollars flow very slowly and are quite sticky. However, the exact opposite occurs in cryptocurrencies since the company that offers the greatest APY that particular week receives the most deposits. Also, everything moves along pretty quickly because most transactions occur on smartphones. Money in cryptocurrency is, therefore, the polar opposite of sticky. At this point, Silvergate made its first mistake. Large financial institutions are required to put their money in high-quality liquid assets in order to weather at least 30 days of strained withdrawals. However, Silvergate Bank only had 11% of its deposits in such an asset. It was only cash, but they needed much more. However, Silvergate Bank was apparently too small to even be required to adhere to the liquidity coverage ratio, and this is where they really screwed up. Moreover, Silvergate Bank was compelled to sell those bonds at a loss in order to fulfill those withdrawal demands because 82% of its deposits were crypto-based. And that's when everything started to fall apart because investors sought to cash out from centralized exchanges like FTX and others that were starting to go out of business. However, if we actually look at the numbers, we see that crypto exposure is so unevenly dispersed among banks that a single institution carries the lion's share of the risk. According to biz.org, Silvergate Bank has 61.7% of the exposure, which is more than the next 4 banks put together. After the bank run caused Silvergate to lose almost $8 billion in client deposits, the bank turned to the FHL bank system for a loan of $4.3 billion. This was money that was only intended to be utilized by FDIC members for things like low-interest mortgages and liquidity. Numerous regulators were upset by the fact that a cryptocurrency company was utilizing FDIC insurance funds to save itself. Luckily, they were able to fully recoup their debt as they took out the loan through the FHL bank system. But this will compel cryptocurrency companies to switch to a new bridge. It implies that they will probably turn to stablecoins. Nonetheless, that carries a great deal of risk all by itself. Without protection, cryptocurrency has evolved into an unpredictable chemical reaction that will inevitably occur the moment it is incorporated into the existing financial system. Everything will start to fall apart once you use a crypto bank the same way you would a regular bank. Not only is cryptocurrency not as sticky as it should be, but it's also not a good idea to back loans and investment-grade goods with something so volatile. Thank you for watching this far. Please leave a like, subscribe to help us expand our future audience, and comment down your thoughts in the comments section. This is Finance Sense, helping you keep up with all the latest trends in the financial markets and the economy. Stay safe and look out for the next video.